All right, the June jobs report topping expectations. So how does this data change the picture for the Fed? Joining us now to discuss is Peter Tchir, head of macro strategy at Academy Securities. So Peter, you wrote in a note early this morning that you thought the dip was worth buying here if we saw a sell-off based on this jobs report. What did you make of the numbers today? What stood out to you in this report?
I think numbers across the board were good. What I liked is that the labor participation rate is increasing, right? So that to me is healthy, right? So we saw a slight uptick in unemployment rates, but anything that's causing more people to come into the labor force, I think is good. It creates a little bit more slack. I also like that the manufacturing numbers were up a little bit. The one theory that we've had is that this trade war, while disruptive, people are going to start pulling jobs back to the U.S. where they can. That takes a period of time, so I would not be surprised to see a little bit more steady increase in manufacturing going forward. So as a whole, I like the report. I think the market was crazy thinking we were going to get 50 bips. Bullard told us only to expect 25 bips. The reality is, if you look at June data, they didn't cut. The data is probably coming in better. We shouldn't cut. I think they talked to themselves in a corner. We do cut. But as you've talked about earlier today, I think the good news is actually going to turn out to be good news for stocks, and we're going to rally from here still.
Yeah.
We saw the reaction initially when the numbers hit. I think the expectation that the Fed's not going to cut as much as initially expected. But, Brian made a good point earlier that Jay Powell's never cited the labor market as the concern. He's talked about the global macro concerns, the trade tensions as well. So in terms of the Fed's thinking, does anything change as a result of the number that came out today?
I think they continue to look at inflation, and they're concerned that that's not going to go much higher. So I don't think that changes that much. And to me, what I really tried to boil down for the last 2 months, to me, the Fed reaction function has changed. They've gone from being slightly hawkish to, I think their behavior is going to be, they're going to be very slow to put on the brakes. So if we get good news, they're not going to turn hawkish very quickly. And any bad news, they're going to react very aggressively to the dovish side. So I don't think that's changed. It might take the pressure off the near term, but I think the market really has to just understand the Fed's got our back. Whether they should or shouldn't, that's a separate question. But I think that's what I've learned over the past 2 months, is the Fed has the market's back. The Fed's going to be reactionary to help the market. And good data is actually good data.
Peter, you made a very interesting point just now on manufacturing. It sounds as if the president might be winning the trade war, if that's your thesis.
Yeah, I think the trade war, there's a great deal of support for the trade war within corporations. I think people have a lot of trouble saying it, but the reality is if you go back in time, almost no one made as much money as they expected in China, and everyone probably gave away more technology than they thought they would in China. And the concerns around Huawei is real. Is there, IP theft? Is this a national intelligence risk or national security risk? So I think Trump is backing up, and I think there's a lot of good reasons to bring some jobs back. What I did like out of the G20, we didn't get it as aggressively, but it feels like at least we didn't come away isolated. I would have liked to see a little bit more of the G18 kind of everyone ganging up on China. We didn't see that, but we certainly didn't walk away isolated. It wasn't like a communique went out kind of singling out the U.S. So I think there's global pressure on China to create a good trade deal. I think we get something in the next 6 to 9 months.
So when you look at this number, and I'm curious for your interpretation on these sort of lines, right? I see it as a sign that there's a lot more slack in the labor market than we think. We're probably not at maximum employment, even with a low unemployment rate. And on that basis, then the Fed would be justified in cutting rates to continue, perhaps even improve the expansion. Does it feel to you like we are at maximum employment? Has that term, I guess, sort of changed? Because we thought 6.5 unemployment was full employment, 5 years ago, and obviously that wasn't.
No, I don't think we are. I think we really need to see that participation rate up a couple more percentage points. So a long way from where we are before I'd get really worried about maximum employment. I think the Fed's fixation on inflation is a little bit bizarre, partly for 2 reasons. One is I think most of us live in a day-to-day world where we see higher inflation, than going, right now, I'm probably going through the worst of it, putting kids into college, where that certainly has a lot of inflation. And then they want to make a big case about inflation expectations. When you look at inflation expectations, at least on the consumer side, it's pretty much correlated with oil. You look at oil prices and you look at inflation expectations, they match very well. Oil's been going up. I know the Fed views it as transitory, but inflation expectations have moved along with that. So I think the Fed's going to have a lot of reasons to pause, which is still very supportive. We're at 205 on the 10-year. That's not going to slow down economic growth.
And then just on the yield curve, because it it's been inverted, but it hasn't really been the headline grabber it was 18 months ago when we first saw that inversion. Does it concern you that we're seeing kind of a persistent inversion of the curve? Obviously, there's technical reasons for it, but in theory, that is telling us something negative about the economy.
Yeah, I think it's a very bad signaling effect as well. So when people are looking at it, you're talking to a CFO or treasurer at a corporation, they're like, hey, we're thinking of doing this project, but we're not sure where the economy's headed. And then they look at this inverted yield curve. It's yet another reason for, hey, why don't we slow this down? So I think the Fed and the Treasury Department should be aggressively trying to steepen the yield curve. I think the Fed with their own balance sheet could do some things where they only reinvest in short term. What I'd really like to see, though, is the U.S. Treasury start taking advantage of the yield curve. They used to issue about 14% in T-bills. We're at about 19% in T-bills. So we've issued heavily at the front end. And this is Mnuchin, who, when he first started, was talking about 50-year and 100-year bonds. They're supposed to do what every corporation in America has been doing, which is extend their debt profile, lock in cheap rates, and that would actually help steepen the yield curve, which I think would be a positive signal for everyone. We could all stop talking about it.
Yeah. Love that idea. Don't hear that a lot. Don't hear a lot about the composition of Treasury issuance. Peter Tchir, Academy Securities, thanks so much for stopping by.
Thanks very much for having me.